and you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target, and ultimately they do want to get back down to pretty close to 2%.
Yeah, and that is totally out of consensus. How much pushback do you get from clients when you bring that up?
I think it's away from market pricing. I don't know if it's as out of consensus in terms of what forecasters are saying. I think there are quite a lot of forecasters and Fed officials. I mean, you just mentioned President Daly. Fed officials who are saying that this is a reasonable baseline.
John, squeeze one more question in here, because the bottom line here is simple. This is the theme of Jackson Hole.
But I think this is the difficulty.
This is the theme.
Jan, 3.5%, if you're going to hold rates at that kind of level, and it could be, I stress you said could be, a couple of years, where does a soft landing fit into that kind of profile, that kind of rates profile?
Well, I think that is a soft landing kind of assumption. If it wasn't a soft landing, if you went into a recession, then I think you would get cuts. But if growth stays at 1%, 1.5%, labor market continues to adjust, inflation gradually comes down, and the Fed in that environment keeps the funds rate relatively high, I think that is a soft landing.
Absolutely fascinating. I think we'll continue this conversation. Jan Hatzius at Goldman. Jan, great to catch up, sir, as always, with Tom Keene and Lisa Abramowitz. And I can see Lisa out the corner of my eye with things to say.
So much.
Things to say, and not on Goldman's HQ,
no,
where it's located, but more just on, can you imagine, Lisa? 3.5% for a couple of years.
I'm looking at investment-grade bonds. The all-in yield was below 2% not that long ago.
You'd have to imagine, to Jan's point, that growth has to hold up for that to happen.
Yeah.
Do markets need to readjust in a different way? Is that what you're suggesting?
Well, we can have a discussion. This is a fascinating one.
The future's unchanged on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Gasoline prices in the US have now fallen for 70 days straight. That's the most in more than 7.5 years, according to the Auto Club AAA. Pump prices are averaging $3.89 a gallon. That is after reaching a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. Credit Suisse is now focusing more on wealth management while it's making cuts to its troubled investment bank. The Swiss bank is reassigning to its private banking international unit, which goes after high net worth clients. That is according to an internal memo seen by Bloomberg. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When the path forward is unclear, do you change your wealth plan or stay the course? Find clarity in specialized expertise and proven outcomes in every economic climate. For now and whatever.
I'm Zoe Thomas for the Wall Street Journal.
Of energy prices in your world, it's something like Ms. Meloni in Italy, with not fascist, but certainly very austere tendencies like what we see in Hungary. How unsettled is Europe given the energy price overlay?
Well, Tom, you've highlighted some of the themes that are interwoven really in the global political risk outlook, where those high energy prices you mentioned, of course, are being driven by the continuation of the Russian invasion of Ukraine, which shows no sign of abating, plus the long-standing Kremlin policy of intervening in European politics. It's not illegal, first of all, for European political parties to actually take funding from other countries. And furthermore, this is long documented. Viktor Orban's connection to the Kremlin, Matteo Salvini, who's on the record today from the Lega Nord party in Italy, saying that perhaps sanctions against Russia aren't working. So while policymakers and markets are, rightly focused on the kind of harrowing inflation outlook, which is taking up the reaction function and the attention, these cracks are really concerning. And the September elections in Italy are going to put a prime minister in office who is uncomfortably close to fascist tendencies and with connections to Russia.
I mean, the shock of the pricing is so tangible. There's got to be my reading of history here, and it may be 1938 on to whatever. You can pick your point of gloom, but the fact is this pricing leads to international relation and political adjustment. What would you suggest that adjustment will be?
Well, at the first level, it's going to lead to enormous household distress. And I see that through the lens of what's happening here in the UK with the leadership contest for the Tory party and the talk about the energy price cap. We're talking about households seeing a quintupling in their energy bills, a normal household paying, over £1,000 a month for electricity. It's a shock that is not going to be able to be absorbed. So first of all, I think there's going to be mass non-payment. And if you look at the dynamics of the Tory leadership contest, it's all about getting those 160,000 Conservative Party voters. It's a different platform. So this government is going to be reactive. By contrast, Macron in France has been more proactive, saying it's basically the patriotic duty to kind of deal with it. And we have to stay strong in the face of Russia. I think that Europe's resolve when it comes to supporting Ukraine will continue, but there's going to be a lot of pain. This is going to hurt. And you asked what the kind of policy response is going to be. People look at the pandemic and they're going to expect government support. How we get there is very hard to say, but the public won't be able to absorb price increases of these proportions.
Tina, you went where I wanted to go, which is you said that the resolve will remain strong to support Ukraine, to battle Russia, and that the European people will continue with that message. When does that fray, especially as power costs rise and there is an increasing chorus of people saying perhaps some of the sanctions and some of the measures taken against Russia were as penalizing to the Western nations as anyone else?
Well, I mean, it's always a question, right, of what's the alternative? And there's no going back to Russia as an energy supplier. Those days are over. And the substitution of supply is already happening. We are, however, looking at a very difficult winter here, one that people aren't used to. In the old days, at least you had a fireplace and you could chop firewood. Now it's central heating, which means people are going to have to turn it off. So it's going to be incredibly difficult. But what you do see in Europe is an increasing sense that Ukraine has to win this conflict. And there isn't going to be a turning back from that. But I guess what I'm trying to say is that maintaining that position of support and the sacrifice that it's going to entail for households means you have to accelerate the green transition. You've got to keep those nuclear power plants going, which is a huge turnaround for German policy. And that's happening rather quickly. Not quickly enough to alleviate pain this winter, but I think quickly enough. And again, we can't go back to Russia as a dependence upon Russia as an energy supplier. They are not a dependable source.
These are huge, huge changes we need to try and adapt to. Tina Fordham of Fordham Global Foresight. And Tom, I really want to pick up on that. I think we're all struggling collectively to process some of these numbers and some of these moves. And we haven't even started to think about the so-called second round effects of all of this. Yesterday, we talked about Citi's forecast for inflation in the UK maybe peaking at 18% in January. It just feels like a number we're throwing out there, Tom, without even really thinking through
I totally agree.
what on earth that means. And Tom, I'd go a step further. I think we have a relationship with the barrel of oil in a way that we don't have a relationship with the gas price. I could tell you gas prices are up by 40% or so in Europe on the month. But Tom, I don't think we really understand what that actually means for the European consumer this winter.
Yeah, and this is really important in that it's part of what we're doing at Bloomberg, and the invention of surveillance and all that, John, is by definition we're removed from all this. But to your point of second order effects, at the second order, the second round, if you will, as time moves on, things change. And where Tina comes in and others in international relations is trying to look to the past and the ghosts of the past and say, what's different this time? And that brings an urgency to the fourth quarter of this year that we haven't seen in ages. These are parabolic moves, John.
Huge moves, Lisa, and really complex issues.
And they're trickling out to just beyond the Eurozone. You're seeing natural gas in the U.S. also surge to the highest level since 2008. So becoming global, raising that issue. How divergent can these economies?
When the path forward is unclear, do you change your wealth plan?
Economies really be?
We'll catch up with an economist next, Jan Hatzius of Goldman Sachs, coming up in about 5 minutes' time from New York. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
The Fed and Powell in particular needs to get across the message that the job is not yet done.
It's not just about what the ECB does and what the Fed does. You have to take into account the market's inflation premium.
We're really playing a game where the market desperately wants the Fed to react.
We are still very much in the early days of recovering off of an extreme low.
Right now, central banks everywhere will take anything they can get.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Bramo's got things to say about Goldman HQ. Just going to share them a little bit. Like, seriously, maybe. From New York City this morning. Good morning, good morning. For our audience worldwide on TV and radio, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures TK positive 0.1%. It is all about the data in Europe, and it's the US next up.
It's about the data, the shock of looking at the Bloomberg terminal. We're going to review that with you throughout the hour and, frankly, throughout our trip to Jackson Hole and what we'll hear from Chairman Powell on Friday. John, I want to go to the Great Divide of America. This is something Jan Hatzius did years and years ago. Macy's just out, John, and buried in it is the comp sales at working class Macy's, negative 2.9%, and at fancy Bloomingdale's, where Mrs. Farrow shops, up 8.8%. That describes the divide of this nation.
The words you don't want to see from retail right now: markdowns, promotions, Lisa, inventory, aged inventory. These are big, big problems that we were hopeful that Target had worked their way through. Macy's, it just seems they're just starting.
The problem is that they actually beat expectations when it comes to sales. However, when it comes to their forecasts, they ratcheted them down because of the expectation of consumers slowing down their purchases. How do you get ahead of such a quickly moving tide of consumer sentiment and the post-pandemic reality, John?
Well, they've had to cut their guidance this morning. Futures right now positive about 0.1% on the S&P. Macy's just about positive as well. On the Nasdaq 100, up by 0.15%. If you take a look at the bond market, yields unchanged at just north of 3%. That's the breakthrough 3 we've seen in the last 24 hours. But the move in foreign exchange, Bramo, you've got to get used to it, haven't you? 99.24 on euro dollar. It's a clean break of parity in the last couple of days. We're down 0.2%.
I keep thinking about Jordan Rochester. Is 95 the next target here, as people expect that downturn in Europe to deepen with higher gas prices? What we're watching today, 9:45 a.m., we do get a series of PMIs out of the U.S. for manufacturing as well as for services. Although at 10 a.m., this is what I'm watching in terms of data. U.S. July new home sales. How much do you see activity in the home market really deteriorate on the heels of higher mortgage rates? At 1 p.m., the U.S. is selling $44 billion of two-year notes. This is fascinating to me, especially as people position for a hawkish speech from Fed Chair Jay Powell. How much interest is there going to be at two-year yields? Yes, you're actually getting something for cash. We've been hearing about that from Steve Auth and others at 3.3%. However, what is the risk of the Fed going much further and staying there longer than people are currently expecting? And we were just talking about Macy's. The earnings season is kind of dripping to its end here. We've got Macy's that just came out. Those shares up now 2.2%. They did beat on the sales. However, they downgraded their overall forecast. We also hear from Dick's Sporting Goods and Nordstrom after the bell. How much does Macy's really become the theme in terms of the mood going forward? What does it say about the consumer, John, at a time where they've hung in there for now, but there's the expectation that it is a temporary resilience that will fade?
That stock this morning hanging in there for now, up by a little more than 2%. Lisa, thank you. Joining us now, we get really lucky. Jan Hatzius, chief economist at Goldman Sachs. Jan, let's talk about it. China, GDP forecast over at Goldman now 3% for the year. Europe, base case for pretty much everybody. They enter recession. Jan, where on earth does that leave the US economy?
I think the US doesn't have quite the same degree of headwinds as both China and Europe. In China, obviously, you have the zero COVID policy and the property market downturn, which is a multi-year development. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but it's going to be a slow growth environment, below trend. The Fed wants below trend. That's why financial conditions are where they are, because the Fed's tightening pretty aggressively. And you've got the fiscal drag. So plenty of headwinds for sure, but I don't think it's quite as bad as in China or the euro area.
How do you expect Chairman Powell to navigate that, Jan, this Friday?
I think he'll be balancing between two things. One, I think he will lay out a case, as he did at the last press conference, as they did in the minutes, for slowing the pace of increases. We had 275 basis point moves. our expectation would be, barring significant data surprises, that the September move is 50. I think I don't think he'll be specific about the number, but I do think he'll be saying, there is a risk of over-tightening, and therefore it makes sense to go a little bit more slowly than these really outsized increases. But at the same time, he'll make clear that the job is not yet done. Inflation is way too high. They're very committed to bringing inflation back down to 2% or thereabouts. So I think it will be a balancing act.
Yeah, and there's a mix here of themes, and one of them is what we just saw from Macy's, where Bloomingdale's and the haves do well, and Macy's and the have-nots really are struggling. Or it could be John Taylor of Stanford visiting with Bloomberg in the last 24 hours, saying sustain, sustain, sustain a higher yield environment. Are we getting our x-axis wrong right now? Do we need to look out 2 years, 3 years, or 5 years of elevated inflation?
I think a year from now or 2 years from now, inflation will be much lower because there are some drivers. I mean, commodity prices are clear. The goods sector in general, I do think that's going to come off a lot. The risk is more on the services side, where we've seen less of an indication that things are slowing, especially rents are still growing very quickly. So I think that's still going to be well above normal, into 2023 and maybe even beyond. So I do think that there are going to be improvements, but not everywhere.
Should we have a more nominal GDP, nominal inflation analysis, witness the haves and the have-nots? The have-nots are getting crushed minute by minute. Should we switch to a more nominal study?
Well, I think what you're suggesting is that we look at the distribution of incomes and spending, and you clearly see some big differences there. And I think, Macy's versus Nordstrom's is a good example. You can look at real income at the top end, at the bottom end of the income distribution. There's been a much bigger pullback at the bottom end, in part because the fiscal support was so much more important there, and that's come off, and in part because at the bottom end, you see more of an impact from gas prices and inflation generally. At the margin, the drop in gas prices obviously is helping somewhat more at the bottom end, but that's only a small part of the previous deterioration.
There is, however, Jan, at least with physical goods, a bit of a disinflationary pressure, whether it comes to inventories or some of the commodity prices that have come off. Is it enough to achieve a soft landing? Have you actually improved some of your forecasts about what the Fed has to do and the outcome in the U.S. economy?
I think it's certainly helpful, and we've continued to be in the softish landing camp, in part because of the expectation that some of the goods pressures would abate. The most important factor, though, is adjustment in the labor market. That's something that they need to pull off, and I think we've seen some encouraging indicators, in particular the 1.1 million decline in job openings that we've seen in the JOLTS data, which is probably still underway. We'll probably see some further significant declines there. That is starting to bring the labor market into better balance. Still early days. We still have a large gap between jobs and workers, but at least we're moving in the right direction there, and I think that's going to be key to sustain it.
Do you think that the market right now is not reflecting what still has to be done, though, from the Federal Reserve in order to achieve that? And this is something that we've heard about throughout the morning. The theme of the day has been that stocks need to wake up to it. That is the bearish tilt. Do you agree with that right now they are not accounting for the pain?
I think the terminal rate pricing doesn't look too low. I mean, it's sort of 3.5 or a little bit more. I think that is sufficient relative to our forecast, maybe even a little bit more than sufficient. Where I would disagree more with market pricing is the pricing for significant rate cuts. I think that certainly could happen and would happen if you went into a recession. But I think in a slow growth environment where the Fed is trying to squeeze inflation lower, I think they'd be very resistant to rate cuts. So I do think that those cuts are probably somewhat excessive from a market pricing perspective.
It's a raise and hold strategy, in the words of San Francisco Fed President Mary Daly. Jan, have you got any idea of how you think they will hold rates at that kind of level? For how long? Is it too early, too premature to have that conversation?
Oh, I think it could be a couple of years. I mean,
Really?
if you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target, and ultimately they do want to get back down to pretty close to 2%.
Jan, that is totally out of consensus. How much pushback do you get from clients when you bring that up?
I think it's away from market pricing. I don't know if it's as out of consensus in terms of what forecasters are saying. I think there are quite a lot of forecasters and Fed officials. I mean, you just mentioned President Daly. Fed officials who are saying that this is a reasonable baseline.
John, squeeze one more question in here, because the bottom line here is simple. This is the theme of Jackson Hole.
But I think this is the difficulty.
This is the theme.
Jan, 3.5%, if you're going to hold rates at that kind of level, and it could be, I stress you said could be, a couple of years, where does a soft landing fit into that kind of profile, that kind of rates profile?
Well, I think that is a soft landing kind of assumption. If it wasn't a soft landing, if you went into recession, then I think you would get cuts. But if growth stays at 1%, 1.5%, labor market continues to adjust, inflation gradually comes down, and the Fed in that environment keeps the funds rate relatively high, I think that is a soft landing.
Absolutely fascinating. Yeah. I think we'll continue this conversation. Jan Hatzius at Goldman. Jan, great to catch up, sir, as always, with Tom Keene and Lisa Brammitz. And I can see Lisa at the corner of my eye with things to say.
So much.
Things to say, and not on Goldman's HQ, where it's located, but more just on, can you imagine, Lisa? 3.5% for a couple of years.
I'm looking at investment-grade bonds. The all-in yield was below 2% not that long ago.
You'd have to imagine, to Jan's point, that growth has to hold up for that to happen.
Yeah.
Do markets need to readjust in a different way? Is that what you're suggesting?
Well, we can have a discussion. This is a fascinating one.
The future's unchanged on the S&P from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Gasoline prices in the US have now fallen for 70 days straight. That's the most in more than 7.5 years. According to the Auto Club AAA, pump prices are averaging $3.89 a gallon. That is after reaching a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell for a second month. August's drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. warns that Russia is about to launch a new round of attacks against Ukrainian government facilities. Ukraine's preparing to celebrate its Independence Day on Wednesday. President Volodymyr Zelensky says that Russia, quote, may try to do something particularly nasty. Credit Suisse is now focusing more on wealth management while it's making cuts to its troubled investment bank. The Swiss bank is reassigning advisors to its private banking international unit, which goes after high net worth clients. That is according to an internal memo seen by Bloomberg. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When the path forward is unclear, do you change your wealth plan or stay the course? Find clarity in specialized expertise and proven outcomes in every economic climate. For now and whatever.
I'm Zoe Thomas for the Wall Street Journal. As you may know, the crypto platform Ethereum is a ledger technology that lets users build applications on top of its blockchain. It's like an operating system for a computer, except instead of being run by Apple or Microsoft, it's decentralized, run by many computers that verify and process transactions. Now, the nonprofit that runs Ethereum is preparing for a major change to how it operates. It's being called the Ethereum Merge, and it's got people in cryptoland very excited. Joining us to discuss what's behind all this excitement and what the change is in the first place is our cryptocurrency reporter, Paul Vigna. Hey, Paul. Thanks for coming back on the show.
Hi, thanks for having me.
So, Paul, start us off with why Ethereum is doing this merge.
So, Ethereum is doing this merge, which is basically a software upgrade. And the software upgrade is going to change the way the network operates. And the design is to make it less environmentally hazardous, to cut down on how much energy it takes to run the network. networks like Ethereum and Bitcoin and all of these other cryptocurrencies really are open networks. Anybody can download the software, log their computer on, and act as an operator on the network. And what Bitcoin and Ethereum do right now is they have these systems and they're called proof of work. But like I said, running all that computing power is extremely environmentally hazardous. It just uses up a lot of energy. So Ethereum is putting in a system called proof of stake. And rather than forcing people to use computing power and thus energy, you're putting up money. You're staking a certain amount of money to be a validator on the network and be one of the operators. They think it might lower Ethereum's energy costs and usage by 99%, which is great. I mean, it's a big deal.
So they're making this switch kind of from one method of doing things to another, and it should have these environmental benefits. But I'm wondering if there are any other benefits that Ethereum might get out of doing this change.
Hopefully what it will also do is it will speed up the processing of transactions on the network, which will reduce bottlenecks. There are a lot of bottlenecks where sometimes transactions there are just too many transactions the network can handle, and it's like traffic on, Route 3 in the morning going into the city. Everybody can't get through the Lincoln Tunnel at the same time. So hopefully it'll reduce bottlenecks, and that will lower the costs to people actually on the network. There's a way that you pay a fee, and the fee is supposed to be small per transaction, but when you get these bottlenecks, the fees they sort of recalibrate so that whoever pays more can get their car through the tunnel faster. So the fees can jump up. I mean, earlier this year it jumped up to $200 per transaction, which is just insane. You can't run a network on that.
In your recent newsletter, you mentioned that while this merge with Ethereum might be good for environmental purposes, it actually doesn't solve some of the other problems that Ethereum has because of its goals. Can you explain that a little bit? I mean, why won't it be better?
Well, what it won't do, and what in my mind is still to this day Ethereum's biggest problem, is that it is just too difficult for the average person to take the time to educate themselves about Ethereum, download the software, run it, figure out how it's supposed to be run, get a wallet, learn how to secure it. I mean, the stories of people who have lost their money because they just didn't understand the security requirements alone are legion. Like there's no deposit insurance. You're not opening a savings account where the bank is ultimately responsible for it. And if the bank fails, the FDIC steps in and makes you whole. You are responsible for it. There's just a lot of steps to being on Ethereum that most people are just not going to take.
So in the lead up to this merge, what has been going on with Ethereum? How have investors and people who use it been reacting?
They've been reacting very, very positively. Since late June, when cryptocurrencies all sort of bottomed out, since late June, the price of Ethereum, at one point it had doubled. It was trading under $1,000 in late June, and it got up to almost $2,000 about a week ago. And most of that was just people getting excited about this merge finally going in, because they've been talking about this and building it for years. And it's gone through a series of delays, and there was never a firm date, and they never knew when it was really going to happen or if it was going to happen. And I suppose you could still have a situation where they have to delay it again, but they've kind of put in a relatively firm date of about September 15th for this to go in. So over the last month or so, people have been getting excited that this is finally going to happen. And traders have used that, as a spark for buying Ether and driving up the price. And at one point, like I said, it was up, more than 100%.
I wonder if this kind of lead up to the merger, if this moment that Ether is having where it's saying we're going to focus on kind of what we do and what our purpose is, it represents any kind of shift in how people are going to think about cryptocurrency more broadly and what its purpose is, particularly given the lower values of some other tokens.
I don't think so. I think it's a good question to raise, but I don't think so. I mean, the merge in and of itself is not going to be the thing that changes all of the cryptocurrency market's fortunes. All of the really, really big issues are still there. The regulatory uncertainty, the lack of security, you really in the crypto markets, if you look around, there's almost a hack a week. The structure of the markets, what we've seen this year is that these things crash hard and there are no backstops. And the lack of any sort of compelling use case is still a big issue. There still isn't much that you can do with cryptocurrencies besides trade them. And that's fine for a lot of people, and that's interesting for a lot of people, and people love making money, so that works. But at some point, you have to come up with a very utilitarian reason for people to be interested in this and to want to use it.
All right, so still a lot of things to consider in this market. And for people who want to keep up with all things crypto, they can sign up for your weekly WSJ crypto newsletter. That's at WSJ.com. All right, that's our cryptocurrency reporter, Paul Vigna. Paul, thanks again for joining us.
Yep.
Australia wants to look at every cryptocurrency traded in the country so it can develop comprehensive regulation. And exclusive documents reveal FTX revenue soared during last year's crypto rally. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto prices in the red to kick off the week, although they're bouncing off the morning lows. By noon Eastern, Bitcoin fell to around $21,000, Ether dropped below $1,600, and Solana dipped to $34. Investors are focused once again on inflation, the possibility of a recession, and a whole bunch of Fed officials meeting in Jackson Hole, Wyoming to discuss the economy. All right, on to the top stories. First, FTX made big money during last year's crypto craze. CNBC's Kate Rooney took a look at the company's financials, and here's what she found.
This is a pretty rare look under the hood of FTX's finances. We got a copy of its audited numbers from last year, and the privately held crypto exchange brought in just over $1 billion in revenue for 2021. That was up more than 1,000% in a year. And as of the first quarter of this year, it was on pace for a similar run rate of about $1.1 billion. FTX was also profitable. Operating income was $272 million, up from just $14 million a year earlier, and operating margins were about 27%. Like others in the brokerage industry, the bulk of revenue comes from those trading fees, but it's much more indexed to some of the more sophisticated trades in crypto. Derivatives were by far the biggest revenue driver, with most of that action happening abroad. Less than 5% of revenue came from its U.S. subsidiary, and FTX has made a big push for that U.S. retail audience. You might remember the Larry David Super Bowl ad. It's also got a lot of celebrity partnerships with Tom Brady and Giselle, for example. According to the documents, it spent about 15% of revenue on marketing and ads and plans to spend almost $1 billion there in the next few years. We'll see if that number changes as crypto companies pull back on spending with prices down so significantly. The documents also give a sense of Sam Bankman-Fried's growing global footprint. The CEO owns FTX Trading, which now owns companies in Cyprus, Turkey, United Arab Emirates, all over the place. It also acquired companies in Switzerland and Australia recently, which may have also been to get certain regulatory licenses. Unclear how the company is holding up in the recent downturn. We don't have those Q2 numbers, but it last raised money at a $32 billion valuation. If you look at shares of Coinbase, it's the only real public comparison out there. That stock is down about 70% since January.
Okay, next up, Australia is ready to reform rules around crypto. The nation's treasury announced its plans to build regulations around something called token mapping. Regulators will examine each cryptocurrency traded in Australia to determine the best way to regulate the industry. The Treasury said the last Australian government prematurely regulated the sector without fully understanding what exactly it was regulating. This agency believes the new method will be more cautious. Last up, Voyager Digital's creditors want to block a payout to its employees. The bankrupt crypto brokerage wanted to pay retention awards for employees who stuck with the company, but its lenders filed a motion to stop those payouts from going through. In the filing, the creditors said, quote, "At a time when thousands of creditors struggle to pay personal expenses, the debtor now seeks to pay bonuses to their already well-compensated employees." Okay, for our main story of the day, let's talk a little bit more about markets. I spoke to Ben McMillan, founder and CIO of IDX Digital Assets, about the recent sell-off. He explains what it says about investor sentiment. So everyone on Wall Street is asking whether we're seeing a bear market rally in stocks or the start of another bull market. I want to get your perspective on that for the crypto market. There was a lot of optimism as we saw big gains in Ethereum and Bitcoin in the past month. Now we're seeing these declines. Are we seeing a bear market rally right now?
I mean, I think that's the growing consensus across risk assets, and crypto's no different. The story this year, and it's not unchanged, is that macro is driving the crypto conversation. So, what's interesting is we've seen a lot of kind of very positive developments that are crypto specific. The idiosyncratic risk, so to speak, looks really good. We had, the news that BlackRock is teaming up with Coinbase for institutional accounts. The market kind of shrugged that off. A year ago, that would have been big news. There would have been a lot of excitement about that, but stuff like that is just kind of being, the overhang of macro concerns, is weighing down on crypto. And so I think, Friday we saw Germany come out with really bad inflation data. China did another surprise rate hike. The data coming out of China looks, worse than previously thought. And, I think investors are bracing for, the fact that there's going to be another leg down in risk markets and, crypto suffering as a result, despite the fact that there's some, good news.
So you mentioned some of the recent triggers, but what are the biggest risks to crypto right now? Is there anything besides inflation or recession risks?
Yeah, so I mean, other than just kind of the general risk-off sentiment, the risk with crypto is always it's kind of like the edge case asset. So particularly as we've seen institutional adoption increase, that means they're more likely to kind of pull risk assets out of crypto first, just in the same way that they were high multiple stocks. That aside, the merge is very good news. That provides a bit of a bid, but I think there's some concerns about regulatory risks. The latest sanctions, the OFAC against Tornado Cash, it's a relatively smaller protocol. But, that sent a lot of concern across the crypto community. And our general sense is that, listen, this is a space that's been the Wild West for a long time. Generally, regulation isn't a bad thing. But, if the regulators come out and there's a turf war between something like the SEC and the CFTC, which, is a concern, that could weigh in the space for a while.
So we have Fed officials meeting in Jackson Hole this week. What does that mean for crypto? What kind of outcomes are we looking for out of those talks?
I mean, it's, consistent with kind of what Powell's talked about all year. I mean, this is a market that is hanging on his every word, basically, not just crypto, but risk assets in general. And so everybody's waiting for, 10 a.m. Eastern when he comes on and talks, in what he says. I think the expectation is he's probably going to skew a little more hawkish in his comments. There was a little bit of a back and forth once the market started pricing in kind of this early pivot. A lot of the Fed chairs came out and said, wait a second, we're going to stick to our guns, so to speak, as it relates to inflation. So I think crypto markets in particular have been very sensitive to that. And they're going to look for any signs that the Fed, might be more or less hawkish relative to kind of where the market is right now.
So you mentioned that pending regulation is also potentially moving crypto prices right now. What about the news out of the FDIC? They issued those 5 letters, including to FTX US, saying that these crypto companies were allegedly mischaracterizing their relationship with the FDIC, with the way that customer deposits were insured. How significant was that news?
Yeah, I mean, I think that's actually ultimately a good thing because, investors look to the FDIC as a stamp of approval. And, to the extent that there's false marketing or alleged false marketing to that, the FDIC is going to want to get in front of that. And that's good because they're going to preserve that credibility to, investors, not just institutional, but also the retail public. So I think that's the kind of enforcement actions that are good for the space. It kind of brings a groundswell of credibility around the FDIC. And more of that ultimately, I think, is going to help increase adoption among the general masses, particularly as it relates to stablecoins.
So where do you think the bottom is for prices of Bitcoin or Ether as they are right now? We had one guest on last week who said to expect a bottom of $18,000 for Bitcoin through the rest of the year. Do you agree with that?
I think that's, technically speaking, that's probably not a bad level. That's where we started to see a groundswell of kind of conviction buying last time around. The joke is crypto can always trade down. There's always a 10 or 20% down move lurking. Our own risk models have started, ratcheting risk down pretty substantially just in the last couple of days here, anticipating such a move. So I think, technically speaking, below 20,000 is where we started seeing a ton of buying come in across not just the whale wallets, but kind of retail wallets in particular. That's also, depending on which miner you look at, that tends to be kind of their average marginal cost of production. Below that, they start taking miners offline. That provides a bit of a bid. Does that mean lower prices are, off the table? Absolutely not. There's a lot of people out there saying that depending on how bad the outlook looks for a potential Fed pivot, what Powell's comments look like on Friday, what the rest of the world looks like, 15,000 Bitcoin isn't off the table. But I do think 18,000, looks pretty reasonable for now in terms of a support.
So what's the state of altcoins right now? Bitcoin is down something like 12% in the past week, but you have altcoins like Cardano down 20%, Solana 22%. Are they more at risk in this downturn?
Absolutely. I mean, anytime you have risk appetite like this dry up, the altcoins are the first to suffer. And it's, they're just the small cap of the crypto space. So it makes sense. You layer on top of that, a lot of these kind of headline hacks that we've been reading about, some of these network outages at places like Solana disproportionately affect the altcoins. They're smaller, they're generally, not as decentralized or not necessarily as durable as Bitcoin or Ethereum. And so, risk off environment really impacts them.
So turning to your outlook for the year, where do you see Bitcoin at the end of 2022? Is it still in this 20 to 30K range?
I would be surprised. Again, a lot of course hinges on the macro environment and kind of where the market's discounting, the Fed pivot or the timing of the Fed pivot, or if there even is a Fed pivot. But I'd be surprised if Bitcoin isn't at, closer to 30,000 by year end. One kind of thing we saw with the rally over the last couple of weeks was it was a different type of buying. It was generally kind of broader in conviction. It was the kind of buying that you like to see before the start of a long-term rally. Of course, macro concerns have pulled that down. And as a result, a lot of institutional investors, including ourselves, have ratcheted back the cash. But I'd be surprised if, as we start to chop through some of this wood going into the back half of the year, there's a little bit more clarity going into 2023. A risk rally could very easily push Bitcoin, up to or past 30,000 in my mind.
Okay, that's all for today, but we will be back. See you then.
LIBOR towards SOFR. There's a lot of just headwinds going on in the front of the market, and that's just made it for a really challenging kind of liquidity market more broadly. And then kind of pulling forward some of the big themes that's going on in the front end of the market, you just come to the shape of the curve. And that has been, a real challenge for economists, for corporate credit investors, just for pretty much everyone involved in the fixed income market.
Winnie, when I mentioned toxic brew and LIBOR, did that cause your baby to scream? Did I make a faux pas?
100%.
Okay, Lisa, pick it up. What I said was, I cause a lot of babies to scream. Lisa, pick it up.
Well, Winnie, a lot of people are screaming about the potential for interest rates. Did you like that segue or segue, as someone would say? When you talk about interest rates and how high they could go, and I want to go to this Jan Hatzius theme of perhaps not hiking rates as far as some people are projecting. The Bill Dudley-esque north of 4%, but at 3.5%. For a prolonged period of time. Has this economy become less interest rate sensitive than many people previously had thought?
Well, Lisa, that's a great question. And I think that a lot of it comes down to the shape of the curve in terms of interest rate sensitivity, especially when you look at the corporate credit market. Right now, we have very flat curves, which from a refinancing perspective is actually very supportive. If you are assuming that a company has a maturity that they then roll over into 10 or 30-year debt, the increase in borrowing costs is not nearly as significant if you're assuming that they're going to be just putting in place more two-year paper and more two-year paper. So I do think that you can't kind of overestimate the vulnerability of the economy in corporate America to higher yields in general, but there is kind of a lot of nuance in the story.
Okay, so the nuance is where I'm actually curious, because there is this belief, and Matt King has talked about this, that you aren't going to see the same default cycle this time around because the maturities have been pushed out, because companies have so much cash on their balance sheets. Do you agree? Are you going to see pockets of real serious distress as you see interest rates at a higher rate for a longer period of time?
So I think that the default cycle is probably going to look a little bit different. We do have an expectation that heading into next year, defaults creep higher, not from a kind of gloom and doom perspective, not a toxic brew, as Tom would say, but definitely a closer to normalization of a long-term default rate. Now, one of the things that we're observing is there's not a really acute pocket of stress in a specific sector. It was energy for much of the past 8 years. It was telecom at one point. It was autos at another point. Now, instead, what we're seeing is these kind of specific pressure points where there are companies that just got their balance sheets highly leveraged. There was some sort of specific catalyst for that business that has been problematic. And the benefit of corporate America for the past few years is that all of those ultra low borrowing costs really buy a lot of time in a rising rate kind of challenged economic environment.
Winnie, one more quickly here, if we could. If you do IG, you know, you're legendary at Wells Fargo over the years, IG, distressed, and all the rest of it. Do you make a 10-year full faith and credit call? Do you have a vision of where 10-year yield will be end of the year or out 12 months?
Yeah, so we do make estimates for the 10-year Treasury market, mostly because you have to have that to forecast where the credit market's going to go. We have a 3.4% year-end forecast on both the 5 and 10 years, so still very flat curves, as we did expect that the Fed is going to hike rates into that kind of 3.25%, 3.5% by the end of the year. Curves will stay very flat, and then we do have the Fed kind of staying on hold at that elevated level for an extended period of time to assess that lag effect between policy tightening and actual economic conditions.
Winnie, thank you. Winnie Caesar of Credit Sites, working through some complex issues. If you would like the weekly dose of JP Morgan optimism from Marko Kolanovic, here's the quote. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China